I'm Mike Greenwald, business tax leader of Friedman LLP, and this is Outlook from the Inside. With us today is Stephen Bokiess. Stephen is a tax partner in our real estate group, and he's going to be talking with us about real estate loan workouts. One thing to know about Steve is an avid traveler to Hawaii. It was something that he always looked forward to as a child, and now when he comes back, he always regales us with stories about it and makes the rest of us who are sitting in New York very jealous. So welcome, Steve.
Thank you, Mike.
To start off, Steve, what is the one best piece of advice that you're giving clients right now?
I tell clients never to let the tax tail wag the dog. Whenever a transaction is considered, the business merits have to take precedence over the tax benefits. Only if a deal makes sense from a business perspective should it be pursued. After that, it can be structured in the most tax efficient manner possible. For example, some people want to buy real estate because they could do a cost seg and potentially write off 20% of the building. Well, that doesn't really make sense if the building isn't going to positive cash flow and the mortgage can't be maintained.
Excellent advice, and excellent advice at any time, but particularly now. Given the total disruption to the normal relationships, particularly those relationships between landlords and tenants, how does a building owner even know what their building is worth at the moment?
It's harder because the market is in disarray. The best thing to do is to try to get comps to the extent that similar properties in the area or the surrounding areas have been sold, see what they've sold for. Different types of real estate is doing better than other types. Suburban retail is getting hit hard. It was getting hit hard, Mike, before the pandemic. It's getting hit harder even now. Suburban office space was starting to die on the vine, but with the pandemic, people are not comfortable going on public transportation. So suburban office space could be seeing a resurgence. And residential rentals was doing well before the pandemic. And pandemic or not, people need someplace to live, and residential rental continues to be very strong.
What about healthcare or logistics? Is that favored property type at the moment?
I think healthcare, with especially now, the more healthcare space, the better. Whether or not that's going to last long term beyond the pandemic remains to be seen.
Should borrowers be approaching lenders at the moment to talk about their loans and see, if there's any relief available?
Absolutely. Whether a borrower is doing well or not, they should approach the lender. Let's start with the positive. If a borrower's properties are positive cash flowing, they haven't really been affected by the pandemic, mortgage rates are at an all-time low. Now is the time to refinance and reduce those mortgage payments. There's no reason not to. If a property isn't performing, it's best to get ahead of the problem, to talk to the lender, try to get a temporary deferral on the mortgage payments or temporary reduction of the mortgage payments. So whether a borrower is doing well or not doing well, there's a reason to talk to the lender currently.
So that's terrific, and it's a great idea. And obviously, lenders have been, at least prior to the pandemic, almost giving money away. But what do I do now if my lender contacts me? In other words, I'm sitting there just trying to run my property, and now all of a sudden I get a call from the lender that they're concerned about my loan.
Well, in this case, silence is not more. It's best to be upfront with the lender, share your cash flows. If there's an issue, talk to your advisors, talk to your accountants, talk to your attorneys, talk to any consultants you have to get ahead of the problem. Talk to the lender, try to come up with a reduced payment schedule, either temporarily or over the midterm until tenants start performing and paying the rent.
So is this a good time while you're talking to your lender? I mean, I guess obviously the thing to do is make sure, which of your tenants are going to be able to continue performing on their end and where you're in trouble on the rent receivable side, correct?
That's correct. I think it's incumbent upon the landlord to be in touch with their tenants. And if any tenant is running into financial difficulty, it's better to know that ahead of time. It's always better in these cases to be proactive rather than reactive. See a problem coming and try to mitigate it to the extent possible.
So now let's say I'm an investor, and you've got all these potential distressed debts sitting out there. Some of them may be securitized loans. Some of them may just be loans that banks or other lenders are looking to offload. Is this a good time? Would you tell me as your client, if I'm looking to invest, should I be going out there and starting to buy up some of this debt?
I would tell a potential investor to wait for maybe 2, 3, 4 more weeks. Currently, the pandemic is continuing to spike. And as it spikes, it causes more economic disruption and probably more damage to the economy.
So you
But I
think,
think currently there could still be hits.
yeah, so you think we're not at the bottom yet?
I wish I had a crystal ball and I knew, but I think there's a very good chance that we're not at the bottom yet.
It's an encouraging thought. Yeah. Well, given that, do you have any other final words of advice for our viewers?
Always be proactive, whether you're doing well or you're not doing well. See what potential problems lie ahead and get ahead of them. It's better to anticipate a problem and be prepared for it than to be reactive. Whether you need to talk to your lenders, your attorneys, your accountants, it's better to always be ahead of anything coming your way.
Well, we all try to be ahead of the curve, but sometimes the curve keeps catching up to us.
Especially now.
Well, thanks, Stephen. I hope you do get back to Hawaii one of these days, and I'd love to join you there.
Absolutely, the more the merrier.
Thank you.